Hey everybody, it's Larry Berman here. Markets never seem to fail to surprise. Just when everybody was piling on the bull train and saying nothing could go wrong, markets have a little bit of a hiccup. A lot of things we learned this week, a lot of things to unpack. Um, we'll take a dive into the chart room in a minute. Just want to talk a little bit about black swans and surprises. The U.S. political situation in the last week between a failed assassination attempt of the former president, the seemingly recognition and forced out of the current president from running again on health issues or whatever it is they figure out that gives him an easy way out. An open, contested Democratic convention coming up, and a Republican Party that says they want to come together, yet Trump picks J.D. Vance as his running mate, which seems to push them a little harder to the right. Um, anyways, the markets are now thinking about full sweep Republican policy and, tax cuts versus can we afford them versus closing the southern border versus all kinds of nationalistic policies in 25 and beyond. So I think that demands a bit of a repricing of market risks. And so let's take a look at the chart room. On policy around debt and deficits in the U.S., the long bond TLT ETF is going to be our best benchmark. So you've got Powell turning the attention onto the labor market this week with some commentary in some interviews he did. You've got the weekly claims numbers ticking up. So, you've got what's clearly a weakening in the labor situation and almost a certainty now of the Fed cutting interest rates in September. And the weakness of economic data in Canada. Yet we heard from the ECB this week that maybe inflation's going to pick up again and they might only be able to cut a little bit. So I do think we're not going to get into a massive easing cycle, but we're just going to be able to tweak it a little bit by taking a little bit of the tightness out of the front end of the curve. But until the economy falls hard, they're not, more aggressive easing is unlikely from the Fed's position. So while they're winning the race on inflation, I don't, for the life of me, think it's dead by any stretch of the imagination. But when it comes to deficits and policy, so you've got the recession story being a bond bullish potential outcome, where TLT breaks to the upside. If I blow this chart up a little bit, we are still very much in a bear trend the last couple of years for the long end. There's no mistaking that. What turns the corner here? Well, the end of a long-term trend like this would be a pattern of higher highs and higher lows. So we would need to see TLT break out and hold above 100 for weeks or months. It can come back into the range, but it would really need to do that and then not go below this 87 area. And that would then establish a trend of higher highs and higher lows. But if you're an Elliott wave type person, in Elliott wave terminology, that would just be a correction to this bear that might mean we have another leg down, i.e. higher yields. Now, if the economy is going to crash or slow significantly, you're not going to see those higher yields. If the economy slows, you're not going to see inflation pick up again. But if you see the policy moves to less globalization, to me, that is inflationary. And so we're not going to see the front end come down and the curve steepen out massively. I really believe that wholeheartedly. So the long end to me is really important here. And so I think we're range bound. I'm a seller of duration. I'm a seller of the long end up in here for sure, but I'm also a buyer down in here on recession risks. So I'm thinking two ways, really at this point. So let's have a look at equity markets, because if all these policies are going to keep rates higher for longer still, equity markets are now responding. But when we look at the leadership in the NASDAQ, while the last week was really ugly from a reversal standpoint and likely means there's more to go, as long as we're above these trend lines, the rising 200-day average being a good one, we could throw up a trend line under here and project it out. As long as we're holding above that, we're in a bull market and the trend's higher and all good. So you're not going to get any panic selling yet. You're definitely going to get some of the late money, maybe trimming a little bit. And so I expect the correction to continue, led by the tech area that's been very, very crowded. And I suspect there's a good 10% downside over the next month, 2, 3 into the US election. So that would maybe equate to 5% on the downside, 6% on the S&P 500. But what we've seen as money's come out of the big tech names, I saw one estimate where it was $700 or $800 billion that has come out in terms of market cap shrinkage. And then what's gone into the small caps, measured by the Russell 2000, was the equivalent of maybe 300 billion. And so you had what looks like a breakout here, but in the last couple of days, again, failed. Because when I looked at this and I said, this is a breakout, it's a rotation, money's coming out but staying in. This is not a real breakout to me. Like, we haven't taken out the highs from 2021. There was a massive amount of resistance up here. It looks like it's still there. Half of these companies don't make any money, but they're way better off with the cost of capital coming down, except if it's only going to be able to come down a little bit. It's probably not going to move the needle too much. So maybe that's the rethink in the last couple of days. So initially money moved, it rotated, and now money seems to be coming out of everywhere. If you look at the equal weight S&P 500, you saw the same thing. The average stock performed really well, and you made a slightly higher high, and now we're failing that breakout. So real big concern this week, in terms of markets. Money went into risk off gold. Gold has a correction as the ECB says, no, we're not going to be raising rates here. We're going to be cutting less. Economy's weak, but inflation's still a problem. And so the whole thought that, the dollar is going to weaken because the Fed's going to ease, and therefore, other markets and commodities are going to go, well, that thesis is maybe in question now too. So, got a lot of uncertainty that's come into the market. Markets don't like uncertainty. You've got the election uncertainty. Tell me why we should be bullish, especially in the first week or so of earnings here, where we've seen some hits and misses, but you're seeing a little bit more cautionary outlooks than you are optimistic outlooks. And it's not surprising. The Fed's beige book this week came out. 5 out of the 12 Fed districts are seeing modest contraction. The last time we saw 5 districts seeing modest contraction was on the eve of a recession, according to what David Rosenberg wrote this week. So, we're a lot closer to a challenging environment than we are with a broadening out and a robust breakout, is my evaluation of this week's events. And so caution reigns. There are a lot of ways to protect your capital. We talked about private equity and private credit, and I know there's some bad narratives out there around it, but a diversified approach to those markets will serve investors really, really well over the next few years as public markets probably need to correct their valuations. Anyways, that's all I have this week. Have a great one, everyone.